On October 24, 1929, nearly $13 billion vanished from the American economy in a single day. By the time it was over, 15 million Americans were out of work. Entire savings accounts gone, families destroyed. A decade of suffering that would come to be known as the Great Depression. History books will tell you it was the system, that it was inevitable, that no one saw it coming. But what if I told you one man did see it coming? And what if I told you another man pulled the trigger? His name was Clarence Hatry. Most Americans have never heard of him, and that is exactly the problem. This is the story of how one financial fraud, 3,000 miles away, lit the fuse that destroyed the American economy and changed the world forever. To understand how everything collapsed, you first have to understand just how good things were. The 1920s in America were unlike anything the world had ever seen. The economy was booming. The stock market was surging. Ordinary Americans, teachers, factory workers, secretaries, were investing in stocks for the first time in history. Between 1920 and 1929, the Dow Jones Industrial Average rose nearly 500%. 500%. If you put $1,000 into the market in 1920 and just left it there, by 1929, you had $6,000, maybe more. People weren't just optimistic. They were intoxicated. But here's the thing about intoxication. It feels incredible right up until the moment it doesn't. Because underneath all that prosperity, underneath the champagne and the ticker tape and the Sunday newspaper headlines screaming about the new American century, there were cracks. Deep ones. And in the autumn of 1929, a British businessman no one in America had ever heard of would walk straight into those cracks, and the whole thing would come down. Why does this matter today? Because the same forces that created the Great Depression, unchecked speculation, borrowed money, blind optimism, and one catastrophic fraud, are alive and well in the modern economy. Understanding what happened in 1929 isn't just history. It's a warning. Let's introduce our cast. First, Charles E. Mitchell. Mitchell was the president of National City Bank, the most powerful bank in America. Today, you'd call it Citibank. He was charismatic, aggressive, and absolutely brilliant at one thing: selling. Mitchell turned National City Bank into something that had never existed before. A financial machine that sold stocks directly to ordinary Americans, not just to the rich, to everyone. By the late 1920s, his bank had hundreds of salespeople fanning out across the country, convincing everyday citizens to buy stocks on something called margin. We'll come back to that, because margin is everything in this story. Second, the American public. By 1929, roughly 1 in every 4 American households had some money in the stock market. That had never happened before in American history. These weren't sophisticated investors. These were people who heard their neighbor made a killing on Radio Corporation of America stock and thought, why not me? And the banks were more than happy to help them. Third, the Federal Reserve. The Fed, created just 16 years earlier in 1913, was supposed to be the guardrail, the adult in the room. But in the 1920s, the Fed kept interest rates low and credit flowing freely. They watched the market balloon and did almost nothing. And finally, fourth, Clarence Hatry, a London financier. Charming, ambitious, respected, or so people thought. Hatry had built an empire of companies in Britain. Steel, vending machines, photography. He was on the verge of his greatest deal yet, taking over a massive British steel conglomerate called United Steel. To complete the deal, he needed more money than he had. And so, Clarence Hatry made a decision that would echo all the way across the Atlantic and bring down the most powerful economy in the world. That decision was fraud. Before we get to the explosion, you need to understand what buying on margin actually meant, because this one financial invention was the gasoline soaking everything in 1929. Here's how it worked. Say a stock costs $100. Under the margin rules of the late 1920s, you only had to put up $10 of your own money. The other $90? You borrowed from your broker. Now imagine the stock goes up to $110. You sell. You pay back your $90 loan. You keep $20. You turned a $10 investment into $20. 100% return in days, maybe hours. People thought they were geniuses. And when it worked, and for a while, it kept working, everyone wanted in. The market went up, so people borrowed more, which pushed the market higher, which made people borrow even more. It was a spiral, a beautiful, terrifying spiral. By 1929, Americans owed $8.5 billion in margin loans. To put that in perspective, that is more than the entire U.S. federal budget for that year. The catch, and there was always a catch, was that if the stock you borrowed against started to fall, your broker would call you immediately. They'd say, pay back part of what you owe, or we sell your stock. This was called a margin call. And in a falling market, margin calls are like throwing gasoline on a fire. Because the moment your broker sells your stock to cover your loan, the stock falls further, which triggers someone else's margin call, which pushes the stock down even more, and so on, until there is nothing left. That was the trap set and waiting in October 1929. And now enter Clarence Hatry. On the other side of the Atlantic, Hatry was running out of options. To fund his steel deal, he had issued what appeared to be legitimate financial documents, certificates that promised investors their money was backed by real assets. They weren't. Hatry had forged certificates, fraudulent collateral. He was essentially printing money, fake money, and using it to borrow real money from British banks. By September 1929, the fraud was unraveling. On September 20th, 1929, Clarence Hatry walked into the office of the controller of the London Stock Exchange. And he confessed. The amount he had fraudulently borrowed, approximately £19 million. In today's money, hundreds of millions of dollars. London's financial markets froze, and the shockwave started moving west. Here is what most people don't understand about the 1929 crash. It did not happen in a single day. It happened in waves, and the first wave started in London. When the Hatry scandal broke in late September 1929, British investors did something entirely rational. They panicked. And panicked British investors did something that changed everything in New York. They started selling their American stocks. Why? Because they needed to cover their losses at home. The fastest way to raise cash was to liquidate your most liquid assets, and in 1929, American stocks were among the most valuable assets on earth. So British money, billions of it, started flowing out of Wall Street. At the same time, the Bank of England raised interest rates. Why? To protect the British pound from the fallout of the Hatry crisis. Higher rates in London meant money that had been sitting in the United States started moving back to Britain, where it could earn better returns. More money leaving Wall Street. The market began to wobble. On October 24, 1929, a day history would call Black Thursday, nearly 30 million shares changed hands on the New York Stock Exchange. 3 times the normal volume. Prices were collapsing so fast that the ticker tape machine, the technology that reported stock prices across the country, fell hours behind actual trading. Investors across America were watching prices that were already ancient history. They had no idea how bad it really was. A group of powerful bankers, led by the House of Morgan, rushed in and bought stocks aggressively, trying to project confidence and stop the panic. It worked, temporarily. Prices stabilized by Thursday afternoon. People exhaled they should not have. 5 days later, on October 29th, Black Tuesday, the bottom fell out completely. Over 16 million shares were sold. Prices collapsed. Margin calls cascaded across the country. Brokers were selling their clients' stocks before they even had a chance to call them. By the end of that day, the stock market had lost nearly $14 billion in value in a single day. And here is where Charles Mitchell comes back into the story. Because in early October, before the crash, Mitchell had been in Europe meeting with European bankers. He came back and told the American public that the market was fine, that the fundamentals were sound, that any decline was temporary. He was either wrong or he was lying. Either way, millions of ordinary Americans trusted him and they held their stocks. And they lost everything. In the weeks and months that followed the crash, the question on every American's mind was the same. What is the government going to do? President Herbert Hoover had an answer. Nothing, or more precisely, very little. Hoover was a firm believer in what economists call laissez-faire capitalism, the idea that markets correct themselves, that government intervention does more harm than good. He believed the crisis would pass if Americans simply stayed confident and kept spending. They did not stay confident. They did not keep spending. In fact, they did the opposite. Terrified of losing more money, Americans stopped buying cars, clothes, furniture, appliances. Businesses saw their sales collapse. Businesses laid off workers. Workers, now unemployed, bought even less, which meant more businesses collapsed. More layoffs. Economists have a name for this feedback loop. They call it a deflationary spiral. But in 1929 and 1930 and 1931, ordinary Americans just called it ruin. By 1932, 1 in 4 Americans was unemployed. 1 in 4. Factories that had been roaring with production 2 years earlier stood silent. Banks unable to collect on bad loans began failing. Between 1930 and 1933, over 9,000 American banks failed. People who hadn't even invested in the stock market lost their savings anyway, because their bank simply closed its doors one morning and never opened them again. The turning point, the moment things began to slowly improve, would not come until 1933, when Franklin D. Roosevelt took office. Roosevelt did something radical. He acted. In the years after the crash, a bitter debate erupted across America. Who was responsible? Some blamed Wall Street bankers like Charles Mitchell, and with good reason. In 1933, Senate investigators would reveal that Mitchell had sold his own National City Bank stock just before the crash to avoid personal losses, while continuing to tell the public that everything was fine. Mitchell was eventually indicted for tax evasion. He avoided prison, but his reputation and the reputation of the entire banking industry was destroyed. Others blamed the Federal Reserve. Economists, most famously Milton Friedman and Anna Schwartz, decades later, argued that the Fed made the crash into a depression by allowing the money supply to collapse by a third between 1929 and 1933. By not printing money and not rescuing failing banks, they turned a recession into a catastrophe. Still others pointed to the Smoot-Hawley Tariff, a law passed in 1930 that raised import taxes on over 20,000 foreign goods. The idea was to protect American jobs. The reality was that foreign countries retaliated with their own tariffs, and global trade collapsed, which made everything worse. And then there were those who said the real villain wasn't any single person or policy. The real villain was greed. An entire culture of speculation, leverage, and willful blindness. From the Federal Reserve to the banks to the ordinary citizen who mortgaged their future on borrowed money and a rising market. Clarence Hatry, for his part, was convicted and sentenced to 14 years in a British prison. He served 9. He later rebuilt his fortune. The millions of Americans who lost everything in the Depression, most of them were not so lucky. Let's talk numbers, because the scale of what happened in 1929 is almost impossible to comprehend. At its peak in September 1929, the total value of the U.S. stock market was approximately $89 billion. By the summer of 1932, less than 3 years later, it had fallen to $15 billion. That is a loss of $74 billion. In today's money, over $1 trillion gone. And while millions lost everything, a small number of people made fortunes. Short sellers, investors who bet that prices would fall, cleaned up. Joseph Kennedy, father of President John F. Kennedy, is widely believed to have shorted the market before the crash. He reportedly walked away with millions while America burned. He later explained his strategy simply: when a shoeshine boy starts giving you stock tips, it's time to sell. He heard shoeshine boys giving stock tips. He sold. Meanwhile, the economic damage radiated far beyond Wall Street. Agricultural prices collapsed, devastating farmers who had already been struggling through the 1920s. Factory output fell by more than half. Construction nearly stopped entirely. The Great Depression would last in various forms until the United States entered World War II in 1941. 12 years. That is how long the fallout from one fraud, one over-leveraged market, and one catastrophic failure of government lasted. The Great Depression did not just change America economically, it changed America fundamentally. When Franklin Roosevelt took office in March 1933, he did something no American president had ever done before at that scale. He used the power of the federal government to directly intervene in the economy. The New Deal put millions of unemployed Americans to work building roads, dams, parks, and public buildings, many of which still exist today. But more importantly, more lastingly, Roosevelt rebuilt the financial system from the ground up. In 1933, Congress passed the Glass-Steagall Act, which forced banks to choose. You could be a commercial bank or an investment bank, not both. The reckless gambling that banks like National City had done with depositors' money was now illegal. The Securities Exchange Act of 1934 created the SEC, the Securities and Exchange Commission, the agency that regulates Wall Street to this day. Deposit insurance was created, meaning that if your bank failed, the government guaranteed your savings up to a certain amount. Never again would ordinary Americans lose their life savings simply because their bank made bad investments. These reforms worked. For decades, America did not experience another banking collapse on the scale of 1929. The Hatry crisis, the margin bubble, Charles Mitchell's false confidence, the Federal Reserve's inaction, Herbert Hoover's paralysis. Each was a link in a chain. Remove any one of them and history might have unfolded differently, but they didn't come apart. They held together long enough to pull everything down. So what do we take from all of this? Lesson 1. Borrowed money amplifies everything in both directions. Margin investing made ordinary people feel like financial geniuses in 1929. Then it destroyed them. Leverage works beautifully on the way up. On the way down, it's catastrophic. This lesson applies to personal finance, corporate debt, and national economics alike. Lesson 2. Confidence is contagious, and so is panic. Charles Mitchell's reassurances kept Americans in the market long past the point of safety. When the truth became undeniable, panic spread just as fast. The emotional cycle of boom and bust is not a glitch in capitalism. It is a feature. Lesson 3. Fraud doesn't stay contained. Clarence Hatry's fraud was a British problem. Or so it seemed. But money is global. Trust is global. When trust collapses in one corner of the financial world, it ripples outward in ways no one can fully predict or control. Lesson 4. Inaction is a choice, and it has consequences. Herbert Hoover believed the market would correct itself. He was wrong. A decade of mass unemployment was the price of that belief. When a crisis is systemic, the absence of a response is itself a response, and usually a destructive one. Lesson 5. The rules we have exist for a reason. Glass-Steagall, the SEC, deposit insurance. These weren't bureaucratic inconveniences. They were hard-won lessons written in the suffering of millions of Americans. And when, in 1999, Glass-Steagall was largely repealed, 9 years later, the world experienced the worst financial crisis since 1929. History doesn't always repeat, but it rhymes. Clarence Hatry died in 1965, wealthy, largely forgotten. Charles Mitchell rebuilt his career after his legal troubles. The Federal Reserve still exists. The SEC still exists. The lessons of 1929 are baked into the architecture of the modern financial system. And yet, every decade or so, someone decides that this time is different, that the old rules don't apply, that the market only goes up. So here's the question I want to leave you with. What shoeshine boy is giving you stock tips right now? Because if history has taught us anything, it's this. The crash was never a surprise. The surprise is how long it takes to arrive. If this story changed how you think about money and history, there's a lot more where that came from. Drop a comment below. I want to know. Do you think another 1929 is possible today? And if you want to go deeper into the financial stories that shaped America, the ones they don't teach in school, you know what to do.